Hey guys, JC Parets here of allstarcharts.com and welcome to the show. Shout out StockCharts TV for having me on. For those of you new here, we do three things. First thing we want to do is we always want to take away a lesson. No matter what happens, there's something that we can talk about that no matter who's listening, who's watching, we can, we can take something away from this, be like, ha, I learned something. That's great. That's number one. Number two, we're going to look at charts, right? What's the market doing? What's up? What's going up? What's going down? What are we buying? What are we selling? What do we want to stay away from? What's got our attention? That's what this is all about, right? And then let's take some questions. Why not? So keep firing them in. Make sure to keep emailing us with questions, and we'll answer them right here. So, okay, what's the lesson? Today, as we're recording this, is March the 31st, the end of the first quarter of 2021, believe it or not. And we got the last trading day of the month, which that means new monthly candlestick charts. So we only get these 12 times a year at the end of every month. And we don't want to look at monthly candles in the middle of the month, just like we don't want to look at weekly charts on a Tuesday or a daily chart at 10 o'clock in the morning. That doesn't make any sense, right? We look at daily charts at the end of the day, right? When the candlestick is completed. At the end, we want to look at our weekly charts on Friday night or Saturday morning or Sunday morning or Monday before the market opens. However, whatever your routine is or some combination thereof is really how I like to roll. Sometimes Fridays I can't help myself. Saturday mornings I love nothing more than ripping through weekly charts. I'm not a newspaper guy. I'm a weekly candlestick guy. And sometimes I'll do that on Sunday mornings, depend on the whole family situation. You know how that goes. But then on monthlies, I get right down to it. So today is Wednesday. So I'm going to go out to dinner with my wife. Then I'm going to come back. I'm going to watch the Miami Heat game against the Pacers. And then I'm going to hit up the monthly candles. And the beauty of this is that it might take half an hour, 40 minutes at most, if you really take your time. I encourage everyone to build their universe of what they think are the most important charts in the world. Email me and I'll send you my list if you like. You know, these are the S&P 500 and the Dow and the transports and the NASDAQ and all those, obviously, but it's also like the US dollar and European banks and some individual bellwethers like Apple and JP Morgan that you give us a lot of information of those particular sectors, things like Caterpillar, right? And the industrial space. We'll look at the different sectors on a monthly candlestick basis and important industry groups, right? So like financials and energy and healthcare, but then also like broker dealers, medical equipment and things of that nature that are really driving these markets. Value growth ratios, emerging markets, US, large caps, small caps, across the board, things like Freeport-McMoRan, copper, gold, the euro, British pound, Japanese yen, a lot of the most important intermarket relationships for sure. So these are what I consider the most important monthly candlesticks in the world. And I'll just fire it up over here. If you email info@allstarcharts.com, what we're going to do is I'm going to email you the slides from this presentation. And then I'm also going to send you my universe of monthly candlesticks, and hopefully that inspires you to build your own universe. You can just copy mine if you want, but that's no fun. You sort of take mine as inspiration and build it for your specific needs. Maybe you are maybe you focus on a specific industry group or sector for whatever your job is, or, whatever your strategy might be. Build a monthly candlestick universe around that, right? A much more intermarket oriented, global, we break it down to individual names, but we start with the global macro. So of course, my list is going to include a lot of international relationships and cross-asset correlations and things of that nature, because that's how I view markets. So sort of cater it to your approach, but definitely incorporate monthly candlesticks and monthly line charts, for that matter, monthly data, if you will, into your process, because very simply, it forces us to identify the primary trends. It gives us no choice. It's so easy to get caught up, what did the Dow do today? What did the market do this week? Blah, 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 right? Janet Yellen and this guy and the Powell and the whole thing and the boat in the Suez Canal. I mean, there's always something. So these monthly data points that we only get 12 times per year and takes half an hour, not only allows us to take a step back, forces us to, right? Forces. It's a beautiful thing, and I think is a huge advantage. It's one of the cheat codes, is what I like to say. And the best part is it doesn't matter what your time horizon is. You could be a long-term investor, and these things are great. You could be a more intermediate term sort of swing trader. These are great because it helps you take a step back. You could be, I mean, unless you're like a day trader. Like if you're a day trader, I guess it probably doesn't matter. But like, how many day traders are really out there, right? Less and less every day, probably. I don't know. Probably not a lot compared to the other 99.9% of investors that are not day traders that I think that monthly candles can be very helpful. So that's the lesson. Get your monthly candles. Step up your monthly candle game. Even myself, that I'm Mr. Monthly Candle guy, I can still improve on my process. Half an hour once a month, 6 hours, the whole year. It is the most valuable 6 hours of work I put in every year times 1,000. I couldn't even tell you what's second place. That's how far away it is. Okay. That's the lesson. Monthlies. All right. By the way, I can't tell you how many emails I've gotten from people over the years that are like, oh my God, JC, thanks for making me look at monthly candles. It's such a huge help. It helps me, eliminate the noise, blah, blah, blah. So when you start, and you know what? If you hate it, email me and tell me how terrible of an idea that was. But if you like it, ping me. Okay. So what's going on, right? Market's a mess. That's been the major theme throughout March. Just messy markets. And I think what's interesting is that it's all happening with crude oil below overhead supply, below this resistance level. That's been trouble over the last couple of years. So it's one of those things where like the correlation between risk and crude oil has been pretty high, right? Most certainly, and that's not always the case, obviously. Go back in time, but you can't argue that in recent years, crude oil has had a high correlation with risk assets in general, including stocks. So the fact that crude oil ran up against those former highs near 66, right? And now we're holding below that, and the market's been a mess while that's been going on. It's probably not a coincidence. That's how I see it. My bet is that that's not a coincidence. That's happening simultaneously for a reason. Emerging markets have been quite the leader off of last year's lows, right? As you can see here. And where are emerging markets having trouble? Well, they had trouble in 2008, right? The emerging markets are acknowledging this overhead supply. So all this is happening simultaneously. Crude oil below overhead supply, emerging markets acknowledging this overhead supply. It's all happening at the same time. I don't think that's a coincidence. From an intermarket standpoint, there's, it's quite obvious the mess that is going on, right? That we are in the midst of. Maybe we're near the end. There's some signals that we're looking at that could maybe signal that the worst is behind us. And then there's some other stuff that we're looking at that if they were to occur would point that it's probably going to be going on for longer. But needless to say, I think these are two very critical levels. The February highs in Aussie yen, February highs in small caps, right? Those are the levels. For below that, I think the bet is messy for longer, right? That's the pain trade, that things are going to be messy. This is a mess, right? We had a team meeting today. We have our team meeting every Wednesday morning where we get together and we start talking about charts and the markets, what's got our attention. And it's like, no one can argue that markets are not a mess, right? Like when you look through as many charts as we do, like you could look at a fraction of the amount of charts that we do and you'll agree that markets are messy. And that's fine. Like that's just a normal characteristic. Go back to the greatest bull markets of all time. You're going to find periods where stocks were kind of messy and they weren't, they were churning and, nobody was really winning. It was just kind of like a mess back and forth within an ongoing advance, right? Which the overwhelming evidence continues to support that it's a mess within a larger ongoing advance. And I think tonight's monthly candles, after I watch the Heat game and follow up again tomorrow morning, I like to go through them a few times because sometimes things stand out. Maybe a couple too many glasses of wine during the Heat game that, maybe I missed something. So you can't screw around with that. So I'll be back on in the morning. But needless to say, I think the monthly charts will most definitely support that this is a mess within an ongoing advance in stocks, not the beginning of something more substantial like a year ago, like 2018, right? All right. So here's what's going on in terms of the overwhelming mess, the leader of the mess, if you will. The ones with the biggest hangover is really what it is. They were the ones that advanced the most last year. The NASDAQ was the big winner, and especially on a relative basis globally, over the last several years, many years, has been that exposure to growth, the lack of exposure to natural resources and financials, which is what the NASDAQ is. And in these days, which we're going to look at in just a minute, the leaders are the industrials and the financials and all of those stocks that the NASDAQ does not have. You're seeing the deterioration there with growth breaking down versus value down here, right? The NASDAQ being a mess with the S&P 500 making new all-time highs and the Dow Industrial Average too, right? When you look at the percentage of stocks that are overbought, fewer and fewer. The percentage of stocks above their 50-day, which is sort of like a short-term uptrend gaze, like a lazy way to say it's in a short-term uptrend. Fewer and fewer stocks, right? We're showing that. Another thing I'd like to point out, when we talk about the breadth, we saw breadth expansion starting last June. Then we got a bunch more in November, small, breadth thrusts, small caps, big time, mid caps, micro caps in November. Then we started seeing it in financials. Even energy had breadth thrusts that we hadn't seen in a long, long time. The one that did not coming into the year was the NASDAQ, which I thought was interesting, which at the time we were like, how is that even possible? And there's a lot of different ways you could look at it, maybe because they did advance more, that it was harder for them to have a breadth thrust compared to something like, say, energy, which to have a breadth thrust was relatively easier because they had gotten destroyed so bad, right? So you can make that argument. But needless to say, the one that's struggling the most in this particular environment is the one that didn't show the breadth thrusts. I don't think that's a coincidence, right? And another thing that I don't think is a coincidence is the market has been a mess with a stronger dollar, right? The dollar has been strengthening in recent months, basically throughout the entire first quarter. And I even joking around, like half joking, I'm like, this is a great party. What's going to be the RA that's going to bust the party and take all our beer? And I'm like, the US dollar is likely to be that. And sure enough, look, we're seeing the dollar strengthen because you know why? Because we've had such a strong negative correlation between dollar strength or weakness and the performance of risk assets, right? So like when the dollar peaked last year, that's when stocks bottomed and started to rally, right? So stocks have done very well as the dollar's gotten clobbered. And then go back before that, stocks were doing very well in a weak dollar environment, right? Going into last year. In fact, the dollar bottomed in the fourth quarter of 2016 after the Trump election, and the market rallied from there. Throughout 2017, the dollar was weakening. Then the dollar bottomed in January of 2018, early 2018, when stocks peaked, right? So again, the fact that we're seeing the strength in the dollar, I guess it shouldn't be surprising that stocks in general, not just growth stocks in the United States, but just in general, emerging markets, we've seen some churning. Not major tops, not crashes, just a mess in a stronger dollar environment. So one thing we'll be watching is for the dollar. Now, within the dollar, I didn't include this chart. I should have. That's my bad. Take a look at Aussie, Euro, British pounds, yen. What's outperforming? What's doing the best? Canadian dollar. Does that say anything about natural resources and energy? Australian dollar's right behind it. The one doing the worst is yen. The most defensive, the safest, yen, getting crushed the most. So when you look at the currency and the relationships of what's going on within the dollar, there's information, right? In the same way that when we look at the S&P 500, we look at the index itself, and then we're like, okay, within the index, you've got financials and industrials and tech and whatever. You've got different sectors. Where's the strength within the S&P 500? Where's the weakness? In the dollar index, it's the same thing. Where's the strength? CAD, Aussie. Where's the weakness? Yen, right? And then compare them. Compare CAD to Aussie. Look at the uptrend in CAD. Compare CAD to Euro and CAD to some of these other areas. Canadian dollar. Looks interesting. So this is something that we'll be watching, sticking with that commodities theme, is this copper gold ratio. There are so many coils. There's so much coiling going on. Look at Google. Looks like coiling. Look at JP Morgan. These should resolve higher if the data is in fact suggesting that stocks are a mess within a larger ongoing advance, right? Copper gold should break out. Interest rates should continue higher because, as you can see here, copper gold ratio and US 10-year yield move tick for tick. So an upside resolution here I think is very important for risk assets. I really do. When did the messy market begin when copper gold ratio stopped going up? I don't think that's a coincidence. It started when oil stopped going up, right? I don't think these things are coincidence. I think these risk assets in general are moving in sync. All right, so where's the strength? All right, where's the strength? So where's the strength? Industrials, new all-time highs. Materials, new all-time highs. Financials, nearly close to new all-time highs. What does this scream? Value stocks. Not a lot of tech in the financial services index, right? Not a lot of tech and growth in the industrial complex. Value. It's funny, I was talking with Rashmi Shastri, who is in India, and she helps us with our Indian research, and the infrastructure sector there, the nifty infrastructure, which is basically a combination of industrials and materials. And as Straza said in our meeting, is kind of a blurred line between those industry groups anyway. So the nifty infrastructure index kind of combines both, which is interesting and showing relative strength. So it's not just a US thing, it's a global thing, for sure. No doubt about it. So let's talk about energy, right? These are the 2016 lows in the energy sector. Again, retested those lows a couple of years ago, and then a year ago broke, right? And that was all she wrote, right? Goodbye. See ya. And now we're back to the scene of the crime, right? Former support turned into resistance. What do you know, right? They teach us that in the second day of technical analysis kindergarten, right? Right after the difference between candlesticks and bar charts and line charts, polarity, support turning into resistance and vice versa is like the second thing you learn. And there it is. Exhibit A, right? What can you say? So this is a great chart. Shout out Grant. Straza pointed out to me. Is the S&P 1500 energy sector and the percentage of stocks in energy that are closing above their 2016 lows, right? So what does that mean? So remember, we're looking at these 2016 lows, right? That's what we're looking at, 2016 lows. So this chart tells us the percentage of stocks in the S&P 1500 that are above those 2016 lows. And we're making higher lows and higher highs in that, right? So if 60% of those stocks are already above their 2016 lows, right? Chances are the index itself is gonna take over. Look at ExxonMobil. That's the one that's struggling. That's well below it. But Chevron is way above it. So, interesting sort of dynamic there. The equally weighted energy index is also above those 2016 lows. So to me, it's inevitable that we break out in energy on a relative, that we break out in energy back above those 2016 lows, right? I think it's inevitable, right? Based on the data, the equal weight's already above, Chevron's above, 60% of the stocks in the energy are above, right? Globally, we're seeing that strength, Canadian dollar, right? Let's talk about what's going on underneath the surface, right? So September 2nd is when everything shifted, right? So that's when value started to outperform growth, seriously, right after Labor Day. That's when that began. And you can see the strength, overwhelming outperformance out of energy, financials, industrials, materials. Those are the value stocks. What are the worst ones? The NASDAQ, tech, right? Right? Staples, because stocks have been going up, so staples tend to underperform. Now, let's fast forward to today, this year, I should say. What are you seeing? You're seeing that value trade accelerate. Energy, financials, industrials, materials, all outperforming this year, right? What are the worst? NASDAQ, tech, right? Staples and Utes, because stocks have been going up. Discretionary, tech, right? This is just another way to show that value outperforming growth trade. All right, so this is important because when it comes to credit spreads, if there's going to be real risk aversion in the market, like stocks are really going to get hit, you're going to see it in credit, right? It's not about coronaviruses and vaccines and hospitals. It's about credit. We've been saying it all along, right? So as the junk bonds versus treasury bonds ratio makes new highs, those are credit spreads narrowing, which are consistent with an environment that stocks are doing well. So sure enough, the ratio is breaking out. S&P 500 is making new all-time highs. That's not a coincidence. Stocks should be doing well if there's no stress in credit. That's the idea. So if you're a perma bear or you think stocks are selling off or this isn't, this doesn't make any sense to you or anything like that, that's fine. You're welcome to have your theory, right? You can have any theory you want. It's fine. My bigger point is I think that you're going to be wrong if this ratio keeps making new highs, right? The short everything, the world's coming to an end trade only starts with lower lows and lower highs in the junk bonds versus treasuries ratio, with credit spreads widening, right? That's not happening. And to be clear, last year it was happening, which is further evidence that supports that this is not last year. This is just a consolidation within an ongoing advance in risk assets. And you can see right here the S&P 500 making new highs a year ago. Credit was already, right? Credit spreads were already widening, right? We're already getting the rollover in the ratio. We were already seeing it. And that's not what we're seeing today. We're seeing new highs in the ratio, right? Last year was different, right? And by the way, I just want to show, in this case, I'm showing the IEF. In this case, I'm showing the TLT. They look exactly the same. So when the duration police starts calling, point to in this one, they look exactly the same. So it's fine. And then, by the way, if you're interested in the slides and in my monthly candlestick list, or my monthly chart list, I should say, because some of them are line charts, just email info@allstarcharts.com. Make sure to use the password, where's the strength? Where's the strength is the password. I give a lot of presentations around the world on a variety of different topics, usually technical analysis oriented, or always, I should say. But for today, if you want these slides in particular, info@allstarcharts.com. Where's the strength is the password. Okay. Now let's take a look at some ideas. This comes from our 2 to 100 club. So remember, these are the stocks that we think are going to be the next $100 billion companies. And based on our filters, mathematically, for them to be the next $100 billion company, they have to come through this list, right? We built it so that mathematically it has to flow through here. So we're looking at names between 2 billion and 35 billion in market capitalization. So when they get into the $2 billion club, now they're a mid cap, right? But less than 2 billion, you're a small cap. So here we're looking at $2 to $35 billion companies that we think are going to be the next $100 billion companies. And we sorted them by proximity to new all-time highs. This is basically the scan that suggests, yes, value is outperforming growth. It's easier to make money in value than I shouldn't say it's easier to make money. It's easier to find a stock that does well in value than it is to find a stock that does well in growth. In the same way that over the years, it's been easier to make money in growth stocks than in value. There have been value stocks that have done very well, but it was just easier to make money in growth stocks, right? We can all agree with that. Now that we're in the opposite environment, it's easier to make money in value stocks as value continues to outperform and shine, industrials, financials, right? All those things, anything non-tech. However, there are going to be growth names, and we're seeing it already. There are growth names that are going to do well in this environment, regardless of whether they're considered growth or value, right? Let's remember that. One's like an asset allocation, institutional money flow conversation. And another one is, let's buy stocks going up, whether they're growth or value, Chinese, Indian, American, Canadian, who gives a damn, right? Boom. 2 to 100 club. One name that stood out to me is this $20 billion semi Qorvo. QRVO. This is a name that popped up on our scan in September. And we wanted to buy it above 122, right? We were buying this breakout here. This was the breakout we were buying. With a target of 177, which was the next logical Fibonacci extension level, right? So here's your highs in 2015. Here's your lows in 2016 when so many things bottomed, including energy, right? We're talking about the 2016 lows in energy. A lot of things bottomed in the January and February of 2016. Continued to consolidate for years, right? Couldn't even make a new high before 2018, right? Still struggling. Finally broke out in 2019, hit that first extension level, consolidated. This is when it got on our radar, buying this breakout above 122 with a target of 177, and that was hit. Now, the beauty of it is that we're not just going to forget about it. It's part of the 2 to 100 club, so it's going to keep popping up on this radar if it's showing strength. Sure enough, it did. So now it sets up a new trade. This has nothing to do with the trade we put on in September. Nothing to do with it. This is a new trade, right? Might as well be an IPO for all I care. It might as well be the first time I ever hear of this stock, even though I'm quite familiar with it, of course. And it's set up for another move higher. So 177 is the level. If we are above 177, I like this long with a target of 270. To be clear, if we're not above 177, then we cannot make the argument that we are now moving on to the next advance. We can't make that argument. So we only want to be long Qorvo if it's above 177 with a target of 270. This one comes from our 2 to 100 club. One of my favorite scans. Always really exciting names doing well there. Helps me discover new names that I had never heard of too, right? Which is great. All right, so this one is the minor leaguers report. This just dropped yesterday. So this is the minor leaguers report. So these are small caps between $1 and $2 billion market cap. So that's the radar, $1 to $2 billion market cap. We are sorting by proximity to new all-time highs. The small caps are doing exactly that. And we're sticking with that theme of value. We're sticking that outperformance in financials. We have a $1.6 billion Texas community bank breaking out on a relative basis, breaking out bigger picture on an absolute basis. So we want to be long VBTX, Veritex Holdings, Texas Community Bank, VBTX, only if it's above 33 with a target of 47. If it's not above 33, we want to leave it alone. We only want to be long Veritex if it's above 33 with a target of 47. And if you're interested in these slides, like I said, make sure to email info@allstarcharts.com. Make sure to use the password, where's the strength? Where's the strength, JC? What are we buying, JC? I get good questions, though. I don't want to make fun. I get really good questions. So fire them over. Fire them over. So we got a couple more minutes. We'll just take some questions. I'm looking for my questions. Here it is. JC, what will signal that more selling is to come? I imagine that you're referring to stocks. What do I think is more? And by the way, fire out your questions to info@allstarcharts.com as well for the show, not just for the slides. Fire them away for the future shows. So what do I think can signal that more selling's to come in stocks? I think if the copper gold ratio breaks down, right, instead of resolving higher, I think that would be that would not be bullish for risk, I think. JP Morgan and Google, these are coiling names, very important bellwethers for their space. Google for communications and growth, and JP Morgan for financials and value for that matter. So I think those are important areas. They're coiling in a tight consolidation. Those need to resolve higher or else. Yeah, those are the things I'm watching for sure. Is it finally time to buy gold? Maybe. I mean, listen, we've been long the GDX, which are the gold miners. If it was above 31 and it's holding, I mean, it's making us money, so we're not complaining about it. Gold, I mean, the outperformer has been in the miners, so we'll keep an eye on that. If the miners keep doing well, we're making money in the GDX. Gold can't be too far behind, right? But man, does it suck. Are higher rates bad for stocks? No, I don't think so. I think copper gold ratio, like I said, breaking out, resolving higher, suggests interest rates are going up. And I think interest rates are going up, inflationary, forces going higher. I think that's good for stocks. I think that's a positive for risk in general. Higher rates, they're going up for a reason. So if you're interested in the slides, like I said, again, info@allstarcharts.com. Make sure to use the password, where's the strength? Thanks for being here, everybody. Adios.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.